Good afternoon, everybody. Thank you very much to all of you who are here in person and those of you who are online today. Welcome to the Wilson Center. This is a very important conversation about America's energy future. For many years now, the Wilson Center has provided impactful programming on global energy issues, and this year we're delighted to announce that under the auspices of the newly created WABA Institute on Strategic Competition, we'll be launching a new initiative analyzing the global energy transition and America's role in that process. And to kick off this exciting new development in our content and programming, I'm honored to introduce Angelina LaRose, Assistant Administrator for Energy Analysis at the EIA. In this role, Angelina directs EIA's Energy Modeling Program, which supports EIA's forecasts and projections. Angelina also manages the topical analyses that EIA produces that span a range of fuels and activities. Angelina has worked in support of EIA's mission for nearly 20 years, working on analysis and modeling for EIA's long-term domestic and international projections, and with her team has produced EIA's country-level analysis and international energy statistics. Prior to serving in that role, for more than 10 years, she worked in natural gas analysis for the EIA. She earned her Master's of Business Administration with a finance concentration and Bachelor's of Government and Politics from the University of Maryland, College Park. Angelina, thank you so much for agreeing to join us today to discuss the EIA's newly released annual report. For those of you who, like me, are true energy nerds, this is always an exciting time in the calendar, and there's nothing I like more than an EIA publication with that new report smell. A word to our audience. We'll have Q&A with the public later on, but please limit your questions to questions of energy analysis, energy trends, rather than policy or politics questions per se, as Angelina's role is one of analyst and modeler rather than policymaker. And of course, the EIA itself prides itself on its policy neutrality and fiercely defends its autonomy within the government. Angelina, you've prepared some slides for us to begin, so I'll now turn the microphone over to you.
Great, thank you, Duncan. And thank you for having me here today. I'm going to touch upon some of the trends from our recently released annual energy outlook. It's hot off the presses. It was released March 16th, so just under 2 weeks ago. I'm going to focus a lot of my remarks on our projections for oil and natural gas, particularly thinking of the Wilson Center and that these two commodities are really what is linking U.S. energy production to the rest of the world. I'm also going to talk about some of the things we're looking at in our international energy outlook as we're putting that together. That's going to be released at the end of September, early October. So as Duncan mentioned, for those of you who aren't familiar with the EIA, we are the independent and impartial organization within the Department of Energy. We are completely policy neutral. And I couldn't have said it, but I can't say it as well as you did, Duncan, but we are fiercely independent. And the reason for this is critical to our mission in providing trusted information to all sides of the energy dialogue, that people know that we're not driving or promoting a particular policy. As such, all the reports that we've released, whether they're our data or and statistics or our analytic products, are only released under the authority of our administrator. So no one else in government, albeit elsewhere in the administration or on the Hill, et cetera, are giving us the green light to release our reports. So before I get into some of the results, I really wanted to talk about what's new in this year's AEO. So as the name suggests, the Annual Energy Outlook is something that we produce every year. I kind of liken it to delivering the mail, but a lot of work goes into it, both in the modeling, incorporating cost updates and better representations of technology. But in addition to this wealth of data and information that we produce with the Annual Energy Outlook, we really wanted to focus this year on the narrative. How are we contextualizing these trends that we're producing and publishing within the Annual Energy Outlook? So I would really encourage everyone who is interested in this product to have a close look at the narrative, because I think we put a lot of work into it. So I'm hoping it's very well received. But it really presents the value behind the work we're doing. We've included technical notes embedded within this narrative to give an insight to the reader into some of our modeling considerations, all of the work that EIA does in terms of our model documentation, our assumptions, and even the model itself is released to the public. But we really wanted people, as they're looking at the results and looking at the Annual Energy Outlook publication itself, to really have a better idea of, like, how are we modeling electric vehicles? How do we consider cost for renewable technologies, et cetera. The other thing that we tried to do, and I'm gonna emphasize in my discussion today, is really looking at a range of results. This is not something new for this year's Annual Energy Outlook in terms of, I hope people realize this isn't a point forecast. These are projections we're looking at, given very specific assumptions. And people should be looking across cases at our results and really understanding what the assumptions that go into these cases are and how they ultimately affect what we're showing. In order to help achieve this, and you're going to see this in the graphs that I'm presenting today, is we're presenting a wide range of results shown in gray. Pretty much all our graphs in the Annual Energy Outlook show this uncertainty, and that represents the bounding cases for a given data series. We have 13 cases in this year's Annual Energy Outlook publication, including several combination cases. This just gives a snapshot. I'm not going to read all the details on this slide, but of what our reference case and what we consider our core side cases are that we released in the main AEO publication, along with these combination cases I referred to. Just a few key things to point out on this slide. Our reference and our core side cases include current laws and regulations. As Duncan mentioned, and within our policy neutral stance, we do not try to create policy in what we're modeling. Our model does not goal seek and work backwards to kind of hint at what a good policy would be to achieve a certain goal. We're operating off a very specific set of assumptions, and this includes the Inflation Reduction Act, incorporating that within our modeling. I would definitely encourage folks to take a look at I'm going to sound a bit like a broken record, at our publication material, because there are some caveats surrounding how we implemented the Inflation Reduction Act within our modeling. Just because there's some, and we have it very transparently laid out in a table of what the dozens and dozens of energy-related provisions are and how we incorporated it, and if we did not, why we did not. And some of the reasons we didn't incorporate all the provisions of the Inflation Reduction Act is some of them just didn't, at this point, have a lot of detail surrounding how they're going to be implemented. They were, for example, they might have a large sum of money for a green bank, but without necessarily describing what types of projects are going to be suitable for accessing these funds. Or also another reason why we might not have incorporated a provision is that we might not have just had the model architecture to support it, and we are constantly developing our models and constantly trying to be more nimble in what we do. So in terms of these cases, the side cases themselves are honing in on these key areas of uncertainty when you're looking out at energy markets in decades in advance. So we have economic growth, which clearly drives the level of future consumption. So we have a high and low economic growth case. We have oil prices, and our oil prices in terms of how we consider them and how we develop them, because they are an exogenous assumption within our modeling. We're looking at different global dynamics. What do we anticipate OPEC supply being, or non-OEC demand, and that provides us this range of oil prices. We have oil and gas supply. How quickly can we extract the resources from domestically from the U.S. and this has a meaningful impact on the price of natural gas in particular, and that in turn affects our generation mix. We have our zero carbon technology cost case. This case is replacing, for those of you who are familiar with the Annual Energy Outlook, this is replacing our renewable cost cases, reflecting how the IRA characterizes zero carbon technologies. We thought it would be best to include nuclear in those high and low cost cases. And then again, just to extend the bounds of what we're showing, we have combination cases that vary the demand assumptions that found in the economic growth cases with the zero carbon technology costs. So it was a lot of information that we're putting out, but it's very critical for everybody to understand, how we consider these things. We also produced this year an issues and focus analytic article separate from our AO publication, but published at the same time, focusing on the Inflation Reduction Act. In this, we, as I've just mentioned, the IRA was a challenge for EIA to model. Part of the challenge was there's also bonus tax credit provisions within the IRA. So depending on domestic content or if something isn't considered in an energy community, you might have a higher uptake of a tax credit. So we ran both high and low uptake cases to compare, our reference case includes our best assumptions going forward about what these bonus tax credits will be. As well as we ran a no IRA case to just as a point of comparison. I'll say I'm not presenting these cases in today's presentation, but one of the interesting things I found as an outcome of this analytic piece is the no IRA case and the low uptake case showed very similar results. So when you have lower bonus provisions, it's very similar to a no IRA case, whereas the high uptake case and the reference case had very similar results, looking out at the trends. So in terms of our highlights, I'm going to largely focus my presentation on the last highlight here, but I wanted to kind of touch upon all the key points that we were drawing out of with our annual energy outlook. Starting with the first one. So by 2030, energy-related CO2 emissions fall by 25 to 38% compared to 2005 levels, depending on case assumptions. Energy-related CO2 emissions are most sensitive to our assumptions surrounding economic growth, as well as the cost of zero carbon generating technologies. Secondly, total installed generating capacity more than doubles across most cases. In fact, just about doubles even in a low economic growth case. And this is owing to the increase in renewable capacity in the grid. So although renewables are, and wind and solar are a free resource, so to speak, when they're not available, you need something to back them up. And so we're showing the model building the capacity in natural gas combined cycles, as well as battery storage. A second reason for this increased growth in installed generating capacity, of course, is the growing levels of electricity demand across the projection period. So that leaves us to our third highlight, which surrounds consumption. So consumption growth within our projection is fairly muted. It's pretty modest. The industrial sector grows the most out of all the sectors within our projections. We do see a increased or a decline in energy intensity across the sectors, as well as increased electrification amongst all the sectors. And this leads us to our last point, and it's something that I'm going to focus my next few slides on. There's relatively subdued growth in the consumption of petroleum products as well as natural gas through 2050 in all cases. But despite this subdued growth in both petroleum products and natural gas, we're seeing continued high levels of exports, and we're seeing that because there's the international demand. We're seeing continued high levels of production because of these increased levels of international demand and exports of our petroleum and natural gas. So this slide is looking at our petroleum projections. The slide on the left shows petroleum and other liquids consumption. You can see that across cases there's only moderate growth to mild declines in consumption. The industrial sector and the transportation sector account for the most liquids consumption in the United States. By contrast, you can take a look at the center graph, which shows production, and you can see a much wider range of results. The values range from continuing high levels of record production in our high oil and gas supply case to pretty kind of like even production in our reference case to declining production in our low oil and gas supply case. Overall, U.S. production remains high because of the international demand of finished products, which support increased levels of exports. And you can see that on the rightmost chart. We project that the United States will remain a net exporter of petroleum products through 2050. In the high oil price case, which leads to increased production, that leads to the most exports across the projection period, where the low oil price case shows the opposite. So I was going to ground ourselves somewhat in what we've seen in the past history. So what are, I'm showing the projections, but what are we seeing in our most recent data? And you can see that the growth in exports is something that has been proved out in recent history. So this graph is showing annual petroleum product exports by type since 2010. In fact, the U.S. set a new record for petroleum product exports in 2022, and it was up about 7% from 2021, and this was led by increased exports of distillate fuel oil, which increased by almost about 20%. The high volume of U.S. Petroleum product exports in 2022 reflects higher prices for petroleum products, and this was largely led to by an increase in petroleum product crack spreads following Russia's full-scale invasion of Ukraine and the sanctions targeting Russia's energy industry. However, this is also a part of a longer-term trend. You can see that petroleum product exports, comparing 2010 to 2022, has more than doubled. In fact, if you look at propane in particular, which is our largest product that has the largest share of exports for petroleum products, in 2010, we exported about 110,000 barrels per day of petroleum. This is compared to what we exported in 2022, which was 1.4 million barrels per day. And this growth in propane is also coming with additional growth in other hydrocarbon gas liquids, namely ethane and normal butane. These products generally flow into the Asia-Pacific region, with Japan accounting for, in 2022, for most of our propane exports. U.S. distillate fuel exports in 2022 averaged about 1.25 million barrels per day, but remain below pre-pandemic volumes. And although certainly we increased our exports to Europe, most of these distillate fuel oil exports went to Latin America. And lastly, just to round it out, our motor gasoline exports also increased to record levels in 2022, exceeding pre-pandemic levels, and most of these are going to Mexico. So looking at natural gas now, these are our projections for natural gas. Similar to the last slide, we see consumption and production, and then on the far right, we have LNG exports, so not total exports. The thing to understand about natural gas consumption, particularly in our model, is consumption in end-use sectors are variable because the largest consuming sectors are the electric power sector, followed by the industrial sector, and both of these sectors are highly price sensitive. In fact, and so they're very sensitive to changes in our assumptions that may affect prices. In the electric power sector, the range is particularly wide, where if you're looking at 2050 and you're comparing the reference case in 2050 to the bounding cases, the difference is as much as 50%. You can see comparing the consumption to the production shown in the center slide. Production is generally increasing in most cases and generally outpaces domestic consumption, except in the low oil and gas supply case and the low oil price case. In some cases, exports to satisfy and growing international demand is actually driving production, and a significant portion of production growth is due to LNG exports, which again you can see on the right side of the graph. We're showing regionally production increasing within our projection in the Gulf Coast and the Southwest regions that have the best access to our LNG export facilities. I won't spend too much time here, but this is, again, just looking at what we're seeing in history as well as includes our forecast. So starting in late 2020, we had LNG exports surpassing our pipeline exports. We're seeing continued growth in the near term in our LNG exports, particularly as Freeport, the terminal, comes back online to full capacity. as well as there's other facilities that are expected to come online through the end of next year. We do still see some growing levels of exports to Mexico as more pipelines are put into service or key interconnects come online. In terms of what we saw last year, we definitely saw an increase in LNG exports to Europe as Russia imports fell to 40-year low in Europe. We had declining LNG exports into Asia. This is pretty much across the board for all the countries, but particularly China that had declining LNG imports across the board, basically, from most of their importing countries. Looking at the rest of the world, in South America, we also showed declines in 2022, and this was led by Brazil because they had a much better hydroelectric year in 2022 than they've done previously. So with that, we are going to be releasing, similar to our IRA issues in focus, we are dedicating and publishing a paper solely focused on our LNG exports. This is going to be coming out hopefully in the next month. And this is going to be looking at, when you're looking at high international LNG prices or low international LNG prices, how does that affect the level of export capacity builds, as well as the overall level of exports coming from those facilities. We're also combining a fast builds case, so there is a constraint in the model about how much capacity can come online at once, recognizing material and labor constraints. So we are lifting that in one case a bit to have fast builds and a high LNG price case, again, to see how that expands the level of LNG exports, and then in turn what effects that will have on domestic energy markets. So I mentioned we are kind of really getting into high gear with analysis for our international energy outlook, which will be published later this year, end of September, early October. We've done a lot of improvements in our international modeling system, and we've worked really hard focusing on that in the last year. But we also did have two stakeholder events where we were really trying to get expert feedback from folks who could provide a perspective to us as we're trying to better model international policies, particularly as pertaining to climate policies, which is a challenge because of, similar to our annual energy outlook, our international energy outlook is current laws and regulations, and how does a policy goal translate into or how does a stated goal translate into an implementable policy? It's something that we wrestle with a lot. As well as we have regional aspects as we're modeling the whole world. So how does an individual country who's a part of a larger region, how does that affect reality, the pending reality as well as our model? We're also taking a much closer look, and we had a workshop surrounding investment. One of the things we see, we have in many aspects, our model, tries to do least cost builds or try to satisfy energy demands through a least cost function. But, increasingly, like looking around again at what is actually going on, there's less and less investment in non-green technologies. So how do we kind of make sure that's adequately reflected within our modeling? So we've had a lot of discussions, and a lot of good work has gone into trying to make those improvements. So I guess with that is the end of my formal remarks, so I'm happy to take some questions.
Thank you so much, Angelina, and you've given us plenty to discuss there. I'd like to invite our audience to submit questions. If you go to the event page online, you'll see that there is a question box underneath the video feed, so please enter your questions in there. We've already begun to get a number of those coming in. But first of all, I'd like to invite you to come back in September for the launch of the International Energy Outlook. I think that'll be a terrific way for us to continue the programming. And I have a couple of questions, if I can abuse my role as moderator here, Angelina. Number one is to say, we see in these projections, is kind of where you were ending, continued strong demand for hydrocarbons in the United States. You say, we're looking at moderate growth there as opposed to, either robust growth, but it is a continuation of robust demand for hydrocarbons. And some people may be surprised by that, given all the excitement that we read about online and in the media about the energy transition and net zero goals. So I wonder if you can go a little bit deeper into that and what is sort of holding up that energy demand or that demand for hydrocarbons.
Certainly. And I'll return to the fact that we are modeling current laws and regulations, as well as, particularly in our reference case, evolutionary technology change. So we don't have, revolutionary technology change. I'll use the example of our electric vehicles projections, because as you will have seen in our petroleum consumption, it declines, and at the end it kind of ticks up at the very end. And that's something that you will have noticed in previous editions of the AEO. So there's a couple of different factors going on there. First, there's just growing, like the demand drivers. I think it's about a quarter more vehicle miles traveled by the end of the projection period than in 2022 in the reference case. And there's also higher levels of income. And so what that does is it kind of it offsets the efficiency improvements that we see in vehicles, both looking at internal combustion engines, or focused on internal combustion engines, of course. In terms of our electric vehicle penetration, it just, one of the things I think was very interesting that we achieved, again, current laws and regulations, evolutionary technology, that our model showed within the electric vehicle space, is that we do have, in the luxury kind of market for our class of cars, light duty vehicles, we do have EVs being cost competitive. But in terms of your question about like, well, what about everybody else, or why do we still have this really large demand for motor fuels in this country, petroleum-based motor fuels, is because in the mass market, we're not seeing that level of cost competition. And so, again, like previous administrators have said before, like what one of the things about looking at AEO's results is it shows you what the world is without further policy changes, right? So again, we're looking at current laws and regulations. And we just have, in terms of natural gas, there's just, we used to say in the electricity sector, like we definitely see, like if you look across fuels in the electricity sectors, you see a dramatic growth in solar. You see a dramatic growth in wind. And you can also see, like comparing the IRA and the no IRA cases, how that's being supported by the extension of the production and investment tax credits. But you still need gas, natural gas. You still need that level of backup in order to maintain grid stability within our projections. So I mean, that's part of the reason why we're still seeing a lot of hydrocarbons being consumed.
Got it. Thank you. A second question that I have for you is about, as you said, this is about evolutionary technological advance. It's about existing policies and trend lines. In terms of major disruptions that may occur, the potential disruptions that could change the scenarios for energy demand and or supply.
Sure.
What do you see that's out there?
I mean, things that we've looked at or considered is, in particular, is storage in batteries. If there's going to be a change in the fuels used for batteries, if there's going to be a longer, or are we going to have longer, grid batteries? I'm trying to think I think we model 4-hour grid storage. Is there going to be an extension of that because of increased technology there? Is there going to be a revolution in EVs that will really diminish the cost of the batteries? Because again, that's a huge part of the cost, of an electric vehicle. Along the same lines, though, like on the flip side, one of the things we're looking at, in fact, in the bipartisan infrastructure law, EIA was given several taskings, and one of them was to look at critical minerals and to look at that critical mineral supply chain, and seeing if there's any, if that could potentially, cause, some supply chain issues that might actually, push this further further away in terms of getting a revolutionary technology. And we are working with the USGS coming up with that type of forecast and folding it into our outlook. So I guess I would say storage off the top of my head, storage technology, I think hydrogen, how hydrogen factors in. I know that's something we've been really wrestling with, in terms of what how a hydrogen market and economy could establish itself in the United States, and what would that look like, and how disruptive would that be to other fuels. So yeah, there's a lot. There's so many. I have like a million. There's so many like costs and the
Yes,
costs of these things. There's like a lot of different considerations.
And lastly from me, and then I'll open it up to the floor here in the room and online. But the outlook for gas and LNG. United States is already one of the world's biggest exporters of gas, and somebody was telling me recently that if trend lines continue, it will become the largest exporter of LNG in the world. Europe, of course, in urgent need of LNG, as we've seen from your slides there. You talked about Mexico's demand that is likely to continue to grow, and depending on how successful it is with the nearshoring phenomenon, may grow substantially more. Where else do you see opportunities for growth in the years ahead for natural gas and for LNG?
Well, in previous editions of our international energy outlook, we've certainly seen a lot of demand in Asia for LNG.
That's a remarkable shift, isn't it, from the redirection of gas from Asia.
Yeah.
They used to go to Asia to Europe, right? For obvious reasons. But,
yes. Well, I mean, what's interesting about global gas markets is that they truly are becoming a global gas market. So much of, I think I'd say one of the innovations of our LNG export facilities is not having these kind of long-term destination-specific contracts. Having these flexible volumes of LNG are really promoting a market where gas is in recent years, maybe 4 years ago, I think more gas was flowing down of our LNG was actually flowing down to South America, and so having that destination flexibility, I think, is important. I think one of the things is interesting to me, and once the Freeport trains are back online, we are the world's largest exporter of LNG, But one of the things I think is interesting is we've wrestled with this issue, particularly when with events in the last year, about how can our LNG exports grow? But there's clearly a capacity constraint from this country. So it comes down to how can you build these facilities? How quickly can you build these facilities? I mean, I think that's kind of a major limitation.
Great, thank you. Questions in the room? We have one back there, sir, and then down here, and then over there. And I've got questions online, yes. Sorry, and please turn on your microphones and introduce yourself.
J.P. Hogan. I'm catching the language that you're talking about. There could be a lower demand with the efficiencies and technology, which brings me to a question I've been asking is, are we already at a point where we can have a low voltage grid instead of the high voltage transporting? It's where with your calculations are you reflecting what used to be high voltage power in a house? What percentage of it now can all be a low voltage system where people aren't plugging in and converting? So it's just we once we start putting batteries in houses and buildings, whether it's a Tesla semi battery could go in a high-rise building and they could locally produce their low voltage, you can really see a drop in demand.
Sure.
So I'm just wondering.
And I'm afraid I'm going to have a somewhat unsatisfying answer, because I can definitely put you in touch with somebody that is something that we're looking at deeply at EIA, but I don't know exactly the answer to your question in terms of where we see that tipping point happening offhand. But that is something that we're considering in terms of, even as I was mentioning batteries. I mean, it is kind of not just batteries. It's not just batteries to back up, to store, unused solar generation, or batteries to improve the range of that you can drive in an electric vehicles. It is, and how does that factor into buildings? How can we have how can your car kind of feed, how can it just be like one type of entity, and is an entirely different way of thinking of things than we have in the past. But it is something that we have considered. I just don't know the exact answer to your
Are
question.
you using a ratio for, in the past, how much what was not low voltage like lighting? Is there now a percentage of a house that can work off 12 volt instead of the normal household
Yeah, no, I know,
voltage?
I understand your question. I mean, I know we look at, we have very specific buildings characteristics that we model, and we have very including, I believe, voltage levels or what. But in terms of how they evolve or how we're coming to that conclusion, I would need to point you into the right direction.
Thank you. David?
I'm in the Middle East, David Ottaway, I'm in the Middle East program. I was just curious, why do you leave crude oil out of all your projections?
We do have crude oil. I mean, obviously, I didn't present crude oil, and that was more on trying to think of what might have been interesting to show. But yeah, no, that wasn't anything intentional. I mean, one of the we are exporting greater levels of crude oil, but we do remain a crude oil importer as well. There's like one of the questions we used to get a lot several years ago is the U.S. energy independent, or energy independent because we're producing so much crude oil? But it's a global community, and so we still have imports and exports of crude oil.
Yeah.
But yeah, that was more, I thought it would be more interesting to look at petroleum products.
I was curious because they're talking about fracking oil, tight oil is peaked, or about to peak, and then we're going to go down. And that would, of course, affect everything. That's why.
Yeah, no, we have continuing very high levels of production within our projections. So in terms of a peaking, we're not showing that in anywhere near in the near term, if that's what people are suggesting.
I mean, one of the interesting things that's going on right now, David, of course, is that a lot of oil companies right now are choosing to not invest in new production because of shareholders that want to take the value at this point in time. And of course, that will result in perhaps a slowdown in production in the short term, but then you'll see a jump in investment again at a certain point, which will boost capacity. Over here, yes, please.
Thank you for the presentation. Tom Pluffjohn with Pangeum. We're an infratech firm based out of Tysons. We focus on long-term concessions for critical infrastructure, largely in Africa and Latin America, but also in a few other locations. Part of our business model requires us to look at passenger movements around the world. Part of that inherently looks at demographics. One of the things that I've been thinking about quite a bit lately is the impact of demographics on a number of these large industries, in particular energy. Can you talk a little bit about your demand assumptions from the international markets for U.S. energy in those out years? The framework of that would be, as we look at some of these demographic collapses that are inevitably coming in a number of the major oil-consuming markets, have you calculated what that means for net exports from our side?
Sure. So in thinking internationally, for our international energy outlook, we have our macroeconomic assumptions, including population, that comes from Oxford Economics. They provide us with their model, and we incorporate it within our modeling system. It's something that we've certainly consider when we're looking. Our models on the U.S. side are very, very detailed in terms of population migrations to like warmer areas and what that means for demand or the changing demand from buildings. We have a different demographic driving classes, or it's very highly detailed when we're looking at it domestically. Internationally, we use a lot of the information from Oxford in terms of the overall demographic levels. So we see, in a country like Japan that has declining demographics, that is factored into or filters through our other demand modules. It's something that because it comes down to how many, what is the number of housing units you need, and things like that. What do you need? Housing units, commercial floor space, and that kind of is factored in led by, again, these projections by Oxford Economics.
Thank you, very helpful.
I'm going to go to some of the questions we've had online, Angelina, if that's okay. The first one is, can solar solve the gap for those utilities that cease to use coal but need to expand generation? And I'm going to tie another question that came into that, which is about limitations in the grid itself. We've heard various stories over the past a few weeks about how there was this enormous rush over the last 12 months to move ahead on renewables capacity, but a lot of companies have faced problems in permitting, but also in terms of getting their connections to the grid. So the question is, how does that factor into the analysis and that first part about the potential for solar to replace coal or to stand in for retired coal?
So in terms of how we model, like, generating capacity and coal retirements in particular, that comes off of an EIA survey. So again, just thinking of the near term, and I'll get to the longer term. So we have what is the retirement, what capacity is retiring, and we have clearly have seen a lot of coal retirements, and we are seeing a lot of solar, and solar in particular is the fastest growing generation fuel across our projection. And you see declines in coal. So even so in the near term, we're seeing in the real data showing that, and then even in our projections, you're seeing that prove out. In terms of saying, well, is that the solution for the utilities? Like I wouldn't want it to presuppose anything, or speak on their behalf, right? But we're seeing. One of the things that's interesting, and it's something we have within our annual energy outlook, is a look at the daily usage of in a given day. What does generation by technology look like? And you can see that you definitely see declines in coal. You see a lot of building in solar, but you see a lot of curtailed generation because of mismatches between supply and demand, and then again that speaks to the need of batteries to help support solar. So again, solar, with solar you need batteries. With solar, and I would imagine a utility or a transmission organization would look at the entire kind of portfolio of available generating capacity, because you see that being pushed. Solar is certainly pushing, I guess, coal and natural gas capacity down, the growth of solar.
Okay. And on the grid, in terms of the capacity of the grid to absorb these new technologies, not new, new sources, rather.
So we do have transmission costs rate within our models, and there are some degree of transmission constraints, but what we're seeing in our projections is that they can support the level of renewables. The grid can support the levels of renewables that we're showing.
Excellent. Okay, thank you. Next question that I have here is on nuclear energy and how that factors into the energy matrix. And specifically, it's given the age of the nuclear installations in the United States today, how long can they keep functioning, and at what capacity? And how long will it take to turn around the growth of nuclear versus its current decline in the United States is the question.
So, as I recall, for nuclear, we have it relatively flat declining. So we do not have growth in nuclear within our projections just because of the high capital costs of building, unless a plant is under construction. We don't have any additional nuclear capacity coming on. It just cannot economically compete with the cost of renewables, or the cost of building renewables generation. We still have it as we still have a share of nuclear generation throughout the projection period. We do look at as we're evaluating generation capacity and technologies, we do are aware of when licenses will have to get renewed and things like that. But nuclear kind of as a base load, still remains in certain areas, but it certainly is not growing.
Right. We've had some interesting conversations here at the Wilson Center over the past couple of weeks on SMR, small modular, and its potential, not just here in the United States, but worldwide. And do you consider that to be an evolutionary technology, or is that?
We do have SMR as a technology represented in our model. So it's not considered revolutionary. I mean, I know there's different technologies even within the SMR space, so we may have more of the evolutionary version of SMR. I do not believe we have that coming on, again, in terms of the economics of that technology compared to wind and solar.
Great. I have one more question here from online, but I want to go back to the room. If there's anybody else in the room who would like to ask. David again?
Yeah, you mentioned briefly hydrogen. Is it going anywhere? Is it too expensive? Do you think it's going to go down and become a significant portion of the mix?
Well, we have not modeled hydrogen, so I know we feel that it's potentially an important enough energy source that we are looking to model hydrogen within our modeling system. We were asked, one of the things we were asked to do by attached to our appropriations a couple years ago is to think about how we could model deep decarbonization scenarios. And as we were considering that, we were thinking of different pathways, not necessarily exclusive pathways, that would get us to like a net zero solution if given the policy or given the economic incentives. Hydrogen was certainly one of those that we considered. We also, in thinking about this, we considered things like direct air capture and or carbon capture. Increased electrification, increasing biofuels. So there's a lot of kind of competing. It gets back to your very first question, like what is the future going to look like? And there's like a lot of different sources that could potentially fill that space, hydrogen being one of them.
I really, in the Middle East and the Gulf, they're pouring tens of billions of dollars into hydrogen. That's why I'm asking the question.
Yeah, and I know there's a lot of effort in England and a lot in Europe, and they're looking at things. I mean, it's something that we are seeing ourselves. We're looking at ourselves and trying to see how to best represent it. And both within our international energy outlook and our annual energy outlook.
It's one of the fascinating things about the energy outlook game, because there are various private companies that do this. There's companies that do scenarios. And one of the things that I've noticed is that if you go back 10 years and you look at them, they're all wrong, of course, because they're operating on assumptions of right then. But they're also very honest about that at the time. As Angelina said, it's about, we're working off these assumptions at this point in time. And they're very, very useful reference cases that point to, perhaps from a policy perspective, and I know you don't do policy, but if you're a policy maker, you see this, you say, okay, so if that's what we get by staying where we are and just with these incremental changes, then maybe we need something a little bit more radical, or we need to go in a different direction. And certainly, the folks in the private sector that we work with, they see their scenarios very much in that regard as well. Had a fascinating conversation with a former student of mine who's at the World Economic Forum the other day, and he's looking at how you actually get to net zero by using radical solutions. So what if we all just mandated that you had to go 50% nuclear by 2050?
Yeah.
What would that do? Another conversation I had recently on sort of the net zero calculation, which is a question that is coming up here. Once you look at the carbon budget and you begin to say, okay, so we've got this many emissions that we can actually put out into the atmosphere. We know that we've already put out X amount. We've got this much left. We're in deep trouble unless we do something radical. So looking at it from that carbon budget perspective. But it's, each year the outcome of these, or the outlook changes based upon what's happening, right?
And definitely, and I think that one of the biggest challenges, maybe clearly, is what are also the costs surrounding like nascent technologies or nascent, fuels. what you mentioned, how anybody in this game, and I always tell all my new analysts, you're going to have to be comfortable with being wrong. Like, you're just going to have to, it's kind of what I guess George Bach said, is all models are wrong, but some are useful. And so it's, I think, because even as you're saying, like, there's certainly anybody who's producing long-term outlooks, looking back through years to years to years, you're going to see where you were wrong. And we actually produce a retrospective analysis. And another thing that we've done this year's AAO is try to looking at how we were, what we missed, or the degree of what we missed, kind of doing a statistical cone of uncertainty on our CO2 emissions and showing the kind of like looking at history and what we had been projecting, how the range of outcomes. But I guess the one thing I was going to say is I know I was interacting with a group in a modeling forum, and if you think about how many people missed shale, and it's not even, and then so you could say, like, the way I think, or maybe the way I justify it in my own mind, like, wow, okay, yeah, that really took off, like, who knew? But then it's not even the first kind of missing of the shale revolution. It's how quickly people innovated the production of shale, and how a bunch of people missed that, And this is, you're talking about a known technology, or an understood technology, or technology that's not just, in demonstration over here, over here, over here. So, like, when you're talking about modeling, or at least at EIA, or as I consider it, like, modeling things that we have very little information on, very little cost information on, it presents a huge challenge. But it's a challenge that we have to take on. I mean, like, it's kind of the reality of where the future's evolving. It is going to be, it appears that there's more of a drumbeat for a revolutionary change than an evolutionary change, and it is something, we're trying to deal with.
Yeah, it can be a dizzying array of factors that you're dealing with at this point in time. By the way, just your comment to your new analysts about you're going to have to be comfortable with being wrong. It's exactly what my family says to me every night when I walk in the door. So
You're talking net zero in the future. If we go to low voltage, every flow in a pipe can be powered. Our water system could charge batteries. So we have the technology that a building could use its water, the pressure in the water system, to turn something maybe not larger than a water meter to charge a battery. And it's a matter of, so we don't have to completely redesign towns and cities and the water system, but all that flow is available now with the ability to run.
every time you turn on a tap, every time you flush a toilet, yes, there's potential energy. Absolutely, absolutely. So let me just, as a final question, Angelina, if I may. Early on in the presentation, you talked about energy-related CO2 emissions. And the question that came in was about the relative impacts of other sources of greenhouse gases. Now, you work for the EIA, not for Department of Agriculture or anything. But in terms of what you've seen, the specific question here is, can you recommend information sources that also consider the relative impacts of other sources of greenhouse gases? But what I'd like to ask you is, as electrification advances, obviously so much of this depends upon the sources of electricity that we're using, but also the supply chain for those sources of electricity. So the critical minerals, which you mentioned, of course, is one of the most disputed areas here. Some people say, well, the carbon emissions that come out of the production process of the minerals themselves, etc. Now, in terms of the modeling that you guys have done on carbon emissions, could you just talk a little bit more about that?
So, and this is a very important distinction to make, particularly because when we talk about emissions, it's energy-related CO2 emissions. So this is the emissions that come from largely come from the combustion of fuel. So we have carbon factors that we apply to our end use consumption, or projections of end use consumption. It's something obviously entirely different than our commitment in the Paris Agreement, because that's something where we don't model land use there. We don't model land use. We don't model other greenhouse gases. We are looking to try to improve our representation of methane venting and flaring within our projections and in our modeling. But yeah, it is a very narrow focus in terms of what we produce in the annual energy outlook and the international energy outlook when it comes to energy-related emissions. So, I mean, it's something that EPA, I know we've worked with EPA, and there's other UN initiatives that are trying to track this, but I'm not aware of anybody who has a...
Yeah. There were some exciting conversations at Sarah Week down in Houston a couple of weeks ago about the need for a more integrated approach to methane emissions and methane capture in particular, because methane as a source of fuel, if you leave out the agricultural side of things, or industrial byproducts, then of course you're missing out on a huge economic opportunity as well as the environmental impact of that.
Yep.
Angelina, thank you so much for answering all of our questions, honestly and directly, and telling us when that's not within your purview.
Sure.
I repeat that we'd love to have you back in September to talk about the international energy outlook. Thank you, everybody, for being here today. Thank you, those of you who are watching online. And please continue to watch for Wilson Center energy-related programming, which will be increasing in the months ahead. Many thanks, everybody. Good afternoon.
Thank you.